All right, good morning again. Thank you all for joining us for BVI Finance's roundtable discussion. I'm Adriana Savral for BVI Finance. Today's Taxing Times roundtable will focus on the status of the Organization for Economic Cooperation and Development's OECD's plans to introduce a global minimum tax rate of 15% in 2023, otherwise known as Pillar 2. We bring together a panel of experts from the world's premier international financial centers to discuss taxing times. Our moderator for today is not me, but it's Oliver Cooper, our lead expert from London on these matters. Before I turn the mic over to Oliver, let me introduce you to our panel of experts. Starting with Oliver. Oliver Cooper is the policy lead at Charles Russell Speechlys, an international law firm based in London. He advises a range of clients on international regulatory matters, such as corporate transparency, information exchange, and the EU and OECD blacklisting processes. He acts as counsel to the IFC Forum, a trade body for intermediaries in the British Overseas Territories and Crown Dependencies that includes several BVI Finance members among its own membership. Away from his day job, Oliver also has an extensive experience in both UK and EU politics. Next, we have Latoya James, who is the director of the International Tax Authority, ITA, and has been since 2015. Ms. James has a wealth of knowledge and experience in law and matters relating to international obligations of the Virgin Islands concerning exchange of information. She holds a Bachelor of Law degree and a postgraduate diploma in bar practice. She also holds a master's degree in advanced legislative studies from the University of London. After being called to the bar in England and Wales, Ms. James joined the Attorney General's chambers as a Crown Counsel, focusing on legislative drafting. In 2014, she was seconded to the Organization for Economic Cooperation and Development, OECD, where she worked as a tax policy analyst. Next, we have Jeff Cook, who is a chair and non-executive director with a strong leadership and governance record in a wide range of significant business enterprises. Through a career spanning more than 30 years, including a spell as CEO of Jersey Finance, Jeff developed an extensive international network working closely with global brand names, regularly interacting with C-suite executives, government ministers, and senior regulatory officials. He has deep knowledge of international finance centers. Jeff is currently chair of Morant Consulting and a chair or non-executive director of a wide range of bank, private capital, family office, trust company, fintech, and trustee boards. Previously, Jeff was head of wealth and management for HSBC Bank, based in London, and responsible for delivering trust and financial planning, wealth, and mortgage services to 10 million HSBC customers in the UK. Then we have Mark Pagno, Director of Economics and Strategy Research Consultancy, Pragmatics Advisory, has almost 30 years experience as a macroeconomics consultant and forecaster, applying economics and business research techniques to markets, industries, and public policy. Before founding Pragmatics Advisory, he held leadership roles in well-known macroeconomics consultancies, Capital Economics and Center for Economics and Business Research, CEBR, as well as policy and campaigning organizations. In addition to a long track record of macroeconomic forecasting and policy analysis projects, Mark has extensive experience of analyzing and researching both island economics and international finance centers, and is a regular commentator on issues relating to them. He has worked with the governments of and/or industry groups in Bermuda, British Virgin Islands, Cayman, City of London, Gibraltar, Guernsey, Isle of Man, Jersey, and Mauritius, and has led seminal research to explain and quantify the value of international finance centers. So with all that being said, we will take questions and answers at the end. I'm so pleased to put your questions in a Q&A box, or Oliver, you know what to do. So I will now hand you all over to our moderator, Oliver Cooper, and he will take you through today's session. Thank you.
Thank you so much, Adriana and the BVI Finance team, to my fantastic panel who are here today, and to all of you attending. And I guess the question we start with is why are we all here today? Over the last couple of years, the idea of a global minimum tax has really dominated a lot of thinking. It's been reported and misreported in lots of outlets, and there's been lots of concern being expressed about what that means for our world. And I think we want to start off today as a panel with discussing really what it means and just as importantly, what it doesn't mean. And therefore, as a result, what it will mean for your clients and you. The first, I think, point to start with is where it comes from. So the global minimum tax in the OECD is obviously it's pillar 2 of a 2-pillar program. And it's been cooked up as a political response to the concerns expressed onshore in the EU and the United States. Pillar 2 itself, as opposed to Pillar 1, which concerns digital taxation, Pillar 2 itself has 3 interlocking parts, all of which combine together to create something that I'm afraid is quite secure and quite difficult to break through. There's not going to be a mechanism by which you can cleverly get round or through those 3 parts. They interlock quite closely, but they're combined to mean that if a jurisdiction implements an income inclusion rule, a subject to tax rule, then there will be a 15% minimum tax imposed on activities within that jurisdiction. That's an if, and we'll get onto that because the agreement doesn't mean that jurisdictions have to implement an income inclusion rule. It's only the agreement that's been signed a couple of years ago in the OECD only means that signatories can't bring a claim against other governments for introducing an income inclusion rule, for introducing a 15% minimum tax. The consequence is that jurisdictions can choose not to do so. And there are, as of yet anyway, no penalties if jurisdictions choose not to introduce a regime themselves. That might lead to interesting outcomes, particularly depending on which jurisdictions do end up adopting a minimum tax. But certainly what it does mean is it means that there'll be no requirement for jurisdictions like BVI or otherwise to do so in their own domestic laws. But if they don't introduce a domestic tax themselves that tops up the amount of tax paid by a multinational group in their jurisdiction to 15%, then it might lead to the right of other countries to impose a top-up tax and increase that level to 15% themselves, effectively meaning that the low tax jurisdiction has ceded its tax base to other countries. Now, that might lead to negative outcomes, but also it means that tax sovereignty still remains in the hands of those small jurisdictions. So that's quite key because the first time that these rules came out in the first instance a couple of years ago, I remember the front page of the Jersey Evening Post, which said end of 0% tax in Jersey. Well, I'm not entirely convinced it means that. And I think it's really key for your clients to understand that it won't necessarily mean that in BVI or elsewhere as well. And the timeline, national implementation, and we'll get onto that in a lot of detail further on, is also up in the air. We've seen a large number of steps towards that in recent months. The EU Council agreed to implementation within EU law in December. The UK is legislating on it in March in its budget. But the fact is the timeline has slipped and slipped and slipped. It was supposed to be, as Adriana said in the preamble, it was supposed to be coming into effect this year. And yet even those countries and jurisdictions that had the pack look like they won't be introducing it until at least tax years beginning after the end of this calendar year, and in some cases a year after that or more. So as a result, the end of the world is not yet nigh. Do not worry about the scaremongers saying it will, but it's really important that we get to the nuts and bolts of this. And I'm going to turn in the first instance on this panel, therefore, and to Mark and Jeff, who bring a huge amount of experience across a number of IFCs. I guess maybe in the first instance, Jeff, you've been, particularly in your role in Jersey Finance, you're involved in a large number of, or observing a large number of these negotiations and programs. What's sort of driving the demand for this global minimum tax? Where is it coming from?
I think it came principally from Europe in its genesis. So there was a concern articulated, particularly in France and Germany, about what they call the race to the bottom on corporation tax rates. And it's true that if you look at historical records across the OECD, corporation tax rates have fallen over the last couple of decades. But in fact, the tax base has broadened, and collectively, countries are collecting more corporation tax than they were 20 years ago. So receipts haven't fallen, but headline rates have. And you know, I think to a degree it's to do with the deficit pressures of many large countries who are short of tax revenue. They have unfunded social welfare benefits that are almost beyond their gift to meet at the moment. So I do think there's a feeling that actually business needs to contribute more because society has pressures. I think that's certainly an EU view that's quite commonly held. I think the other lever or the other driver was really, it's partly tied up with Pillar 1, but it was a driver for this too, I think. And that is the amount of tax being paid by American digital companies, particularly in Europe, where you've got very high headline sales and revenues, quite low profits, and relatively small amounts in relation to the turnover being paid in tax to European countries. So I think those are the two principal drivers in Europe. But then I think the whole initiative, it got a boost from the OECD's effective adoption. They were already working on, how to modernize global tax laws because of the digital economy. And if you look at the BEPS work, that was the one thing that was it recommendation 15? They put it on one side as kind of for a while. It's just too difficult. And we've got other priorities. But I think the EU push got them focused on trying to deliver solutions. And then I think the big game changer was when Janet Yellen, the US Treasury Secretary, voiced her support for the direction of travel, which hadn't previously come from the US to any degree. And that, I think, really got a real lift behind the initiative. So that's where I think it came from.
And Mark, from your perspective, I mean, the reporting about it, the idea is a bit of sea change in tax policy and the end of zero taxes. I mean, that's not my understanding of the rules. Is it yours? And to an extent, why is it misunderstood if it has been?
I think we'll come back later, I suspect, Oliver, to think a little bit through what the practical outcome is of all of this. But your interpretation is certainly shared, I think, by those who've actually had a go at reading the damn stuff in terms of what this means. I think the misinterpretation, I'm going to come from this at a slightly different perspective, and I think it's an important one for the audience today as well, which is that I don't, but a lot of the people on this call live and breathe this stuff. And for them, tax is important. Actually, for most people on the other side of the spectrum who are reading those newspapers, tax is firstly boring, and secondly, tax is for the bulk of those people a pretty automated process. People don't get engaged generally in the nuances of tax. So for me, it is completely unsurprising that these very complicated and nuanced arrangements, and that have become even increasingly nuanced as the negotiation went through, because of all international agreements, it always takes a lot more. It takes a lot more side deals to get to your end outcome. It's no surprise to me at all that those very nuanced international deals have ended up being quite simplified and misrepresented in not just the common press, but actually in some of the more technical press as well. And when you try and reduce it to a 3-letter acronym, I noticed the notes around this are all about GMT, which I thought was a time zone. But nonetheless, when you're in this way, for the nuances to be missed, I don't think is a surprise at all. And I think actually that's one of the things that we need to be mindful of when we think of the world from an IFC perspective, is that you live and breathe this part of the world, this part of arrangements. The rest don't, and it's very easy to misunderstand what happens in IFCs. And I think in that exact same way, it's very easy to misunderstand what a global minimum tax is when a global minimum tax has been brought in to satisfy the needs of the US, to satisfy the needs of France and Germany, and also, importantly, to satisfy the needs of getting Ireland on board as well, towards the tail end of this, and various Eastern European states. And what you've got is you've got a relatively complicated, and you're right, quite robust, actually surprisingly robust arrangement that comes out from the global minimum tax. And it's there fudging all those different requirements. And again, later on, we'll talk about some of what those fudges might be. It's unsurprising that therefore it's not fully understood and represented. And I think a part of what the IFCs need to do is both recognise what the global minimum tax is and isn't, but also recognise that actually they are probably still going to be at a much higher level of debate and understanding than the bulk of their client base. in the onshore world.
And Latoya, you were nodding on there from the government's perspective, from the ITA's perspective. I suppose, has this come out of nowhere, or does it feel to BVI like it's a culmination of previous initiatives? Is it different, I suppose, to previous requirements that have come along before?
I am so sorry. I have too many screens open. So initially, it did feel different. I think what you said in your introduction was what many jurisdictions thought. This was the introduction of a 15% tax, and the BVI would have to adjust its tax system to accommodate it. But as we've been looking at it as it developed, we're seeing that it's kind of going along the same way as every other international tax matter has developed, and it may affect the BVI in the same type of manner that CRS, FATCA, and all of these different types of arrangements have actually affected us. I think what we will be seeing is that the BVI would be having to provide information to jurisdictions that have to apply this type of tax. You know, the BVI government has put a lot of resources into the International Tax Authority to make sure that we're able to follow the ever-changing landscape. It's changing every year. Something new has been introduced, and this is no different to those things that have been introduced. We kind of right now look at it kind of an extension of country-by-country reporting, because they've not changed the definition of the M&E groups. They've not changed the definition of excluded entities. What we think would be happening, of course, though, is that there may be a change in the type of information that we would have to share to those jurisdictions that would be applying this 15% tax. So for a while, we have been growing. The ITA started off as a part of the Inland Revenue Department back in 2008, when we just enjoyed exchanging information with the US under a tax information exchange agreement. And we have come a long way now, where we have as the tax world has changed, so has the requirements changed. We're now not just focused on information exchange, we're also focused on the compliance aspect and the implementation aspect. And along with this GMT, we believe that there would be some sort of compliance or reviews that have to be conducted by the ITA, but we do believe that the focus would be information exchange.
That's really interesting. I think that where that takes us next is what other countries are doing, and therefore what impact that will be on BVI. Obviously, if you have if you had a structure that had a BVI company, a BVI subsidiary within that structure, and its headquarters, ultimate parent entity, were in a country that did implement an income inclusion rule, it could lead to higher tax imposed on that structure to top up the amount of tax that would be paid in BVI from its current, obviously, 0% to 15%. And so I suppose the impact on structures that do include IF vehicles in international financial centers will depend on how it's implemented elsewhere. I've mentioned the EU legislating currently for it, the UK doing it in its budget in March. Japan said it will do it by the end of this year, and Australia has as well. But other than that, it does seem, and we'll get onto America in a bit, because they're always, as per usual in a sui generis, sort of standalone situation of their own. But other than those sort of European countries, Japan and Australia, it does seem like most of the world is not going to be implementing, at least in the next tax year or two, an income inclusion rule. Does that mean that, so I suppose maybe a question to the panel, I'll turn to Mark as an economist on this, maybe turn to Mark first about what should really determine what will determine how jurisdictions respond to GMT, whether they implement them, whether they don't, and how they respond to those big countries doing so.
I'm glad you pointed to me as an economist. Most people laugh when I say that. there are two levels to this. I think there's a very interesting theoretic debate about global minimum taxes and tax and the extent to which you've got tax harmonization and what the implications of that is. And then there's the practical impact of what this set of arrangements do. And my view on this set of arrangements, actually, for the large range of locations and activities out there, is that they don't do that much at all. Actually, the rate has been set at such that all it did was put in terms of bigger nations and developed nations, it only really put the Irish noses out of joint, and they followed suit quickly at any rate. It's a set of arrangements that provide, you're right, a very nice and robust regime, but a regime that actually doesn't have particularly much of a bite in terms of the values that are being used. So I think it's important, before we get too worried about the different things that could happen, that we recognise that actually this is a regime that isn't one which is actually, if implemented and stays as it is as implemented, isn't something which is a particularly big difference to what the world was previously in reality. However, there is still the question of what could be done if, for example, 15% went up, or for those jurisdictions where the 15% is something of an impact, and there are some where that's the case. And then that really again comes down to the nature of the entities we're thinking about, fundamentally, what a global minimum tax does, if it is set at a level which has some sort of bite, what a global minimum tax is doing is it's removing one of the levers that a nation state have got to demonstrate the competitiveness and to provide an incentive for location. So there are other levers that are out there as well. So what you might see is you might start to see a rebalancing towards corporate income tax, away from labour taxes, or away from sales taxes, for example. You might also start to see, to some degree, some re-looks at the extent to which there are regulatory and other incentive type regimes that could be deployed. Now, at this level, I don't think that's going to be something you're going to see a great deal of in many of the larger states. Most of them could be untouched by this, in fact, will benefit from a local minimum tax. You might start to see something in some of the peripheral European states that will do something about that. Actually, where this has a bigger impact will be in developing nations, and where typically not the headline rate of tax, but most definitely the ability to offer tax breaks has been a very big driver of inward investment. And a driver of the incentive to a policy-driven inward investment in a number of developing states. And I think that's where actually these policies are going to be the most significant. When we think about the IFCs, you've got two main types of IFCs. You've got the ones that are driven by tax double taxation agreement networks, and they are going to see some of their business impacted by this. If you think though the others, which are the tax neutrals, well, you said previously, Oliver, that tax sovereignty remains in the hands of the small nations. Well, they never had it to start off with, in many respects. And fundamentally, I'm afraid the likes of the BVI, the likes of the Jersey, the big boys can do what they like to you, and they've always been able to do that, and they'll carry on being able to do that. And in many respects, actually, the introduction of a global minimum tax doesn't do that much to the changing of the real politic of what you can do and how you can do it. I think the danger of a global minimum tax is that it suppresses the overall amount of cross-border activity, the overall amount of investment, the overall amount of businesses trying to expand internationally, and that then would have a knock-on impact on the offshores. I don't think the 15% level is enough to do that, frankly. But that for me is the fundamental danger of this, is by reducing tax competition, by reducing the incentives. What you might have is a world which is less global, and with that probably will be less prosperous, will be less efficient, and would have an impact on the scale of the market for the offshores as well.
It's really interesting. I think the other sort of the corollary, the flip side of what we were discussing about what happens when jurisdictions impose it, the flip side is what happens when major jurisdictions don't implement it. So, for example, mainland China has not given any indication that they will implement it. The same is true of many developing countries. The same is true of Hong Kong and Singapore and many others I could continue naming. And if you had a structure that was entirely within, so let's say, an IFC that did not implement it, it could be BVI, it could be someone else, and those jurisdictions, then there would be no top-up tax imposed anywhere, and those jurisdictions would be, and that structure would be entirely unaffected completely by global minimum tax. It's not really global in that sense. But Jeff, how, from the IFC's perspective, how should IFCs respond? I know that Jersey is the only CD or OT to thus far have launched a consultation proposing how to deal with it. But I don't know if you want to talk through what Jersey's proposed or how IFCs should be responding given sort of pressures that Mark and I just discussed.
Yeah, so I think Jersey and other IFCs have tried to avoid falling into the trap of thinking this is a mandatory tax that you've got to install into your. So if you don't have a corporation tax system, you've got to install one. And if you do have one, then you've got to be taxing a minimum 15%, and it isn't that at all. It's something though that places like Jersey and all members of the inclusive framework, the Global Forum has given some protection against the kind of discriminatory actions that Mark outlined, where the powerful act against the small. It's always been that way, hasn't it, throughout history? The Global Forum has given a degree of protection and a kind of sort of level playing field, not a perfect one, but a sort of level playing field to the British IFCs who participated in that. And I do think the folks in the OECD, if you meet them, they do try and act equitably and fairly when they're kind of developing these rules. So I think it's been in the interests of British IFCs to engage with the OECD, because if you have a universal set of rules, then it applies to everybody. And if there's some detriment to it, well, everybody feels it. It's not you being discriminated against. So that's a safer place to be and a better place to be, I think, for IFCs than to kind of go it alone. I think they'll deal with this pragmatically. I would be surprised if in any kind of early wave, any IFCs install their own minimum tax at 15%, because I don't think it's a covered tax. Unless you're part of the kind of overall, unless it's widely adopted under the model rules. And also, I'm not even sure whether you do a double tax treaty to make that work. So you might tax, but then it might get taxed again by somebody else, unless you've got universal adoption of the OECD global model. And it doesn't look like we're going to get that at the moment. The adoption's quite patchy, and it's different in different countries. Actually, there's some, particularly the US. So I think IFCs will take a pragmatic view of this. They'll look at what they need to do to put their best foot forward as a responsible cooperative member of the global financial community. And I think that's about information sharing, not about changing your tax system. And you've got to also think about the thresholds. So, 20 billion of revenue turnover for Pillar 1. I think Pillar 1's an awfully long way off being implemented, by the way, much, much further back than Pillar 2. But Pillar 2, 750 million euros of turnover before you have to actually perform any kind of calculation. That's, you need quite large groups to trigger those thresholds. So my thinking would be in the tax neutral territories, which are much more often about private investment by private companies. Yes, some listed work, but quite often private companies. Those thresholds won't be tested too often. So I think it will become an administrative burden and another cost, where you need staff to kind of do it. And because it's complicated, it will need people to kind of look at it quite carefully. But that will be about exchanging information on the profits of those subsidiaries or entities of groups that sit in your jurisdiction that appear to be triggering that threshold. And I think that's as far as IFCs need to go at this point. And I think it's what most of them will do. Because to do anything else would be in danger of upending their current tax systems completely. It would have to really convert them quite dramatically. The CDs would have to look for something beyond tax neutrality through zero, and the overseas territories who don't, have different kinds of taxation systems, would need to reinvent themselves completely. And I just don't think that's a reasonable ask for small jurisdictions with limited resources. And I don't think even the OECD would expect them to do that. So I think a degree of pragmatism will come in, a kind of watch and wait, careful monitoring, complying as we see things develop if it takes the kind of turn we think it is. I think where the risks come is if the EU decides it's going to do something a bit different to everybody else. So far, it's not signaling it will, but if it decided to make it a listing criteria, licensing, and being a member of this scheme was a listing criteria, then that could be a bit more problematic. If it's still just about information sharing, then that's fine. And my current understanding is that having a 15% rate isn't mandatory for anybody under the rules. You can join the scheme and exchange and agree that you will cooperate with the income inclusion rule and the taxation of profits in your jurisdiction. It's just somebody else will be taxing them and not you. So I don't currently see a huge risk from it. I just see another burden, another administrative task, another cost, and a bit more complexity. But beyond that, I don't see too much risk at this point in time. The risks actually are far more to jurisdictions like Ireland and Luxembourg, Netherlands that Mark outlined, who depend very much on delivering tax neutrality through double taxation treaties. And I think that will be caught by this, and those flows will be a little bit more difficult. And they tend to manage larger companies. One of the genesis of this was the American companies who have their regional headquarters in Ireland. That was part of the big drive for the EU to kind of pursue this. So I don't think there's anything to fundamentally worry about, but neither should we be complacent. And I think people will be carefully monitoring developments, and in a state of readiness to adopt and implement, but principally on an information sharing basis.
I think that's fascinating. And if you look at the sort of, you mentioned there, Jeff, that there's this common framework of implementation that countries will sort of feeling out how others are implementing first before they get to it. One country that I mentioned I mentioned in passing earlier that has legislated for a 15% minimum tax is the United States, through the Inflation Reduction Act in the summer. They introduced a corporate alternative minimum tax, CAMT. But that rule, those rules of that diverge significantly from the OECD framework. So, for example, whilst the OECD framework is based on a country-by-country assessment of how much a multinational group pays in each country, and then allows other countries to potentially top up the amount paid in country X or Y to 15%. The US framework is based on a blended approach, which just looks at how much the multinational group pays in all foreign jurisdictions combined. And it also allows quite generous R&D credits and other deductions and allowance special preferential regimes, which the OECD rules are deliberately designed to prevent. And so for two reasons, the US regime diverges very significantly from the OECD rules. I'm not going to get into US politics, but the consequence of the midterm elections in November and the election of the House of Representatives chair of Ways and Means Committee in a couple of weeks ago mean that it's very unlikely that the US would amend its regime anytime soon to be in alignment with the OECD. Now, I call this the American torpedo, because it diverges so significantly from the global rules, the world has a choice. They have to assess whether the American rules are the same as the rest of the world, which of course they're not, but they have to assess it anyway. And if they pretend that they are the same, as for example, the world pretends that FATCA is the same as CRS and pretends the US exchanges information under CRS, if it does do that, there'll be a great sucking sound bringing business, or at least ultimate parent entities of corporate groups, to the US, which would mean that all the group would be outside of scope. And if it's not seen to be equivalent to the rest of the world, there'd be huge double taxation of US headquartered multinationals, leading to potentially the mother of all trade wars between the US and those countries like the EU that impose it. And that puts, I think, the whole system in flux and into question. Maybe I'll pause there and ask Jeff about that process, that's a peer review process the US has to go through where other countries assess it. And you've been involved in sort of looking at the peer review process, because Jersey has been so involved in those processes over the years. How does that dilemma get resolved, or can it be?
Well, I think something would have to change beyond the current status quo, because what we're getting is tax and trade policy developing incrementally. And there was a convergence at the time that Janet Yellen voiced her support for the OECD global tax. I mean, she visited Europe and went to see, I think, Poland and one or two other outliers that weren't too keen on trying to persuade them this is the right thing to do. And it was a surprise, I think, to Europe to see the American book income tax come in, but that had been a campaign trail promise of Biden. And then they tried to get it through on the Build Back Better, failed. And then tried to bring elements of it back in the Inflation Reduction Act. But then even that was opposed. So the current, as I read it, the current AMT is a compromise tax. It's there to assuage voters in the domestic US. It's not, it doesn't look like how it started, because the things that they said they were going to do away with, like the sort of accelerated depreciation and the R&D and the sort of offsets, I mean, bizarrely, these were things that were passed by previous Congress because they wanted to encourage a certain type of behavior. They either wanted to discourage something or encourage it. And a lot of these things are about actually encouraging investment. So the reason that some of these companies have this big tax gap between book tax and their corporation tax liabilities, they've been investing. And eventually, over a span of time, over many years, those things tend to equal up, tend to equalize, and the difference isn't actually too great. But in a single year, it can look very great. It can look like, firms had enormous sales. It's got quite a decent profit, but then that profit is wiped out by carry forward losses from previous investment. But that's exactly the kind of behavior that governments want to encourage companies to do, which is to invest, create jobs. So it's a strange, dysfunctional sort of position we find ourselves in now, I think, where these things don't make sense. They're not very logical. And there certainly isn't an alignment between the two tax systems. So the EU directive on corporation tax and the OECD's proposals look nothing like the American book tax. I think the only commonality really is that the OECD system and the AMT are both calculated from financial statements rather than corporation tax calculations, which are usually a separate exercise. But that's the only point of commonality that I can see, really. So they're not. I can't see them being reconcilable. So unless somebody turns an enormous blind eye and says you're okay, US, because you're big and powerful, I just don't see how you could ever present any kind of coherent case to say that actually it satisfies the globe rules and is equivalent to the OECD or what the EU have done. The EU have broadly adopted the OECD model as proposed. They've not varied it really. So it's worrying in so many fronts. The Inflation Reduction Act is troubling the Europeans because they see all these green energy subsidies going on in the US. They're worried about relocation of some of their big clean tech businesses. And we're lining up for, I think, as you said, quite a significant dispute between Europe and the United States at a time when we all really need these great powers to be working together, given that some of the horrible things that are going on in the world, particularly the war in Ukraine and the problem with Russia, and a number of other not so stable autocracies around the world. So there is no solution on the table I can see at the moment. And I think if it doesn't get solved by the US moving towards the global minimum tax model, i.e. adapting as they go, having fulfilled their domestic sort of political promises, I think there could be a very significant falling out between the great powers. And you could see the digital services taxes start winging their way back onto the agenda in Europe. You could see reciprocal state aid, something that's been absolutely anathema for the EU for the last decade. You could see state aid coming back in the EU, and you could see tariff wars triggering those sorts of things. So this in itself isn't a big enough issue to trigger off all of that. But there's so many other things going on that are part of the same pattern of the US, if you like, trying to lead a Western liberal democracy alliance in terms of some of its challenges against autocratic states, but at the same time, looking very, very firmly into their domestic political situation, which is tense and difficult, and doing things purely for that domestic audience. And that's why we've got higher interest rates in the US. That's why we've got a strong dollar that's hurting many parts of the world. That's why we're at risk of recession in many parts of the world. Apart from the energy crisis, those problems aren't actually global problems. They're US problems, but they're exporting the impact to the rest of the world because of their domestic challenges. And it's very difficult for American politicians. They're on a real knife edge because their political system is so equally divided. It's actually very hard to do anything. So so it is challenging. I don't see a ready or easy solution, but one hopes that the reason that they've come together around the coalition around some of their wider challenges, concerns about China, concerns about Russia, concerns about a war in Europe, it will hopefully make them see sense and actually start getting around a negotiating table and trying to collaborate to make these things work collectively.
So I guess given those domestic pressures, it might require some sort of pretense to try to get everyone back on the same hymn sheet. But Mark, do you see there being a mechanism which they can have a scalpel out that fixes, that does the cosmetic work that needs to be done on this? Or I mean, what would be the impact of treating the US as being not equivalent? Would that be such a game changer?
I share a lot of Jeff's views, I think, on this, but not all. And I think the realpolitik is that if the states wants to go in a different direction, everyone else is going to let it. Nobody's going to stop it, and fundamentally, the decision is: do we cut ties if you're in Europe, or do we facilitate? I cannot pretend to understand the detailed nuances of the differences between the two regimes, but it feels to me as if it is undoubtedly ripe for a bit of Brussels fudging and play. And I think it may look like we're some distance away from it at the moment, but having some sort of regime which isn't double taxation, isn't necessarily globe consistent, but is effectively 1 point something taxation, which permits the tax paid in the US to be recognised in a European compliant system, seems to me to be something which is eminently doable in the way that Brussels does its international negotiations. So I don't see there being it's all or nothing. I see there being that usual grey, absolutely no internal consistency or logic to it, Jeff, quite right. It doesn't make any sense, but you can imagine there is a peas soup at the end of this, which is a system which allows the Europeans to get sort of what they think they want and allow the Americans to carry on doing what they're doing, just in the same way that's been found pretty well every 10 years for every issue that's popped over the North Atlantic Alliance, effectively, since the Second World War. So I think that's doable. But where I do really agree with Jeff, and I must put the plug in for the report that will come out soon from BVI Finance that I had a small hand in. I think the bit which is true is that we are potentially at a bit of a fork in terms of what does geopolitics look like, what does globalization look like, and there are definitely different scenarios out there for where the world might go. And one could see that if we end up in a world which we've called in the report the block economy, where actually you start to see the world fragment a bit into larger blocks that are internally very open bordered, but externally against each other, those blocks are starting to rub up against each other. You could see this as being one of the different components of a very different world where Europe faces up against Asia, but also faces up against North America as well. And I see the questions around what's going to happen to the global minimum tax more in the through the prism of what's happening to geopolitics rather than global minimum tax driving what's happening to the geopolitics, if that makes sense.
Could I just chip in and respond very quickly? I actually agree with that. I presented sort of a bit of a polarized position, but I do think folks will see sense and there'll be some kind of compromise, some kind of fudge. This isn't big enough or important enough for the Western powers to fall out. You know, if you look at the OECD's estimates, which I think are probably optimistic, but even if you accept them, the amount of cash this will collect in the overall scheme of things is tiny. I think their highest projection was $250 billion. Well, the annual budget of the British government's about $800 billion. That's just one country. So, you know, if you put it in the overall scheme of things, you know, it isn't important enough for the great powers to fall out. There's so many other things that are much bigger and much more important. So I do think some kind of compromise will be found. I just don't know how far, which party will have to move towards the other to get that compromise, particularly given in the US now that the situation is as it is. Over the next years, I think it's going to be very hard for the US to agree very much of anything. Yeah.
Certainly agree with that. And so, Latoya, from the BVI's perspective, every initiative that's come out in the last sort of, I guess, since the launch of the Global Forum 14 years ago, and the sort of peer review process and peer review mania that kicked off, BVI has been a really staunch player within those processes, even when there hasn't been a huge amount on offer directly to BVI itself. So CRS, BVI does not have a direct taxation system. So under CRS, it provides information to other jurisdictions and doesn't receive it back in return. Does BVI, I suppose, will it be taking a position on other jurisdictions' implementation of GLOBE or an interpretation of it, or is BVI more likely to, as in previous initiatives, sort of been a good global player and team player and not stick an oar into those giants negotiations?
I think we will continue to adopt the same type of position. What we are is a jurisdiction that cooperates, and we want to continue to be a cooperative jurisdiction. As you have said, over the years, we have dedicated a lot of resources into being one of those jurisdictions that simply gives information because of it's just the circumstances that we are in, because the BVI hasn't adopted a tax system. So we have been an information giver. One of the things we can't get away from in the BVI is the size of our registry. So even though we don't have taxes, it makes us very relevant for these types of work in information sharing. And I don't see it any differently when it comes to GLOBE. We just said a lot earlier on jurisdictions thinking about implementing taxes. And I think for us right now in the BVI, we have to take a pragmatic approach, and we have to be very careful in what we decide to do and how we actually decide to get involved in this work. To move from a system where there's no taxes to a system where we'll be implementing or some sort of 15% tax would be very burdensome on the government of BVI. There's a big shift in the way we do things. It would be a very big administrative burden. It would be a very big endeavor for the government to try to implement implement something like that. So we have to be very careful in the way we approach it and how we would be looking at implementation or the role of the BVI in GLOBE. It is very early days for jurisdictions like ours. What we would continue to do, as we've done with everything else when things have been implemented, is of course to work directly with the OECD on how they see these would affect our jurisdiction and how they see us as players in this work. And as I said before, I do think that it would end up more being similar to other regimes where we exchange information and assist jurisdictions in actually implementing any type of tax or any 15% tax that they have, rather than the BVI seeing such a very quick shift in implementing a new tax system. But of course, that does not mean that the BVI government can't take a different approach, but it will be a wait and see game, I guess.
Great. We'll turn to Q&A in a few minutes. So if you've got any questions, get them pouring in the Q&A box. But just finally, I guess on the business impact, we discussed some of Jess mentioned some of the sort of exemptions that have been a bit underappreciated. The fact that if you don't have a business turnover of 750 million euros, in 2 of the last 4 years, and that structure is out of scope. Funds, collective investment vehicles of all sorts are deliberately carved out of scope, and that carve out will be quite broad. There are others. Given, I guess, to turn to Mark in the first instance, because you've written about the makeup of the BVI, you've studied quite extensively the makeup of the BVI sector. Given the BVI's sort of business focus on Asia, Latin America, jurisdictions that don't look like they're going to be implementing a globe minimum tax in the first instance, what do you think the impact will be compared to jurisdictions that are more dependent on Europe and those that have implemented it?
To be honest, I'd be surprised if there was that much impact in the BVI business stock at all, frankly. We've got firstly the nature of what BVI does often in these structures, but also importantly the extent to which, you know, we reckon somewhere in the region about 45% by value of BVI BCs are probably somewhere in the China area, or originate from somewhere in the China area. The extent to which the geographical focus has moved a little bit away from Europe over recent years, but the geographical focus isn't particularly in those areas which are going to be impacted early, and the way in which the structures operate as well. I would be surprised if the global minimum tax would actually be that material impact at all, and what the BVI does. You know, my view for Own Town is there are much bigger fish to fry and to be worried about than the global minimum tax.
And maybe, Jeff, on that point, you mentioned earlier that it might become sort of a criterion for blacklisting in the EU or otherwise. Do you think that's a concern that BVI government should, or BVI businesses should have going forwards?
It's an outlier consideration at the moment, because they have said that they want to come closer to international standards. There's been a debate, hasn't there, about the nature of EU blacklisting within the EU, and a desire to come nearer to FATF and observing their list, not running 2 lists. And they've worked quite closely with the OECD on this, and the OECD, I think, would take a dim view of even a bloc as large as the EU devising its own, if you like, ancillary rules surrounding the main thrust of things, to say, I'm not quite happy how you've done that, so we're going to list you. It would be quite an extreme action, and I think probably not likely, but in this world of perpetual uncertainties, I guess you've got to keep every possibility in mind. So so in terms of the Channel Islands or the Crown dependencies who have conventional tax systems based on 010, I don't see any change at this point in time. I think they will collaborate with the OECD and with the EU, where equivalence recognition is quite important, and good neighbourly relations. You know, where I'm sitting at the moment is only 15 miles from the French coast, so we're a lot nearer to them than many other IFCs. So that's something you kind of carry in mind. So I think it will kind of move forward on that basis. It will be looked at carefully. Yes, there's always the option of implementing it fully, but you know, I think that's probably not likely in the sense of adopting, you know, 15% corporation tax rate. And you have to think about, you know, how does it impact you? How relevant is it to the proportionality, which was Mark's point, I think. So here, our big industries are banking and funds, 2 largest industries. Institutional work, really, has progressively moved to be an institutional jurisdiction. And they're not involved in this at all. They're not caught really by this. So if you look at companies, there are only 34,000 companies on the Jersey register, and only a tiny proportion of those, I would suggest, are going to meet these value thresholds. So the overall impact actually will be, I think it'll be felt more administratively than it will be felt financially. So I don't think there's any need to do anything precipitate. I think we can comply and reaffirm that sort of reputation, as the BVI does, and others, of being a responsible corporate global citizen. And if the OECD agree amongst the Global Forum, which 140 countries, that this is a good thing to do, I'm sure we'll do it. But the degree of adoption, I think will vary, and we will do enough to show genuine commitment and respectability, but probably not overcook it.
Yeah. I'll turn to Latoya and then Q&A in a second. I would note just, I might be too optimistic here and thinking that actually global minimum tax might present sort of an off-ramp from the reputational threat and harm that's been done quite often by onshore policymakers to jurisdictions like BVI that have 0% tax or nominal tax. Because for so long, it's been suggested that the imposition of 0% tax in BVI and elsewhere means less tax take within EU countries, in the UK, etc. But for the first time ever, global minimum tax is an explicit statement of global intent that actually the less tax you pay in jurisdiction X, the more tax you pay in jurisdiction Y, if you have a structure that crosses that border. After so long of 0% tax, of IFCs that rely on 0% tax being delegitimized and being demonized for having their different economic model to the rest of the world, it might end up being time that they become re-legitimized, because all of a sudden it's impossible for the presence of a 0% tax rate in BVI to drain tax from EU countries. If you had a structure across the two, you might end up having a higher bill in the EU as a consequence of BVI being so charitable and altruistic. But that's just me being perhaps a bit too Panglossian and optimistic. I realize that in Brussels, London, and Washington, it's a lot more about vibes and facts. But Latoya, any final thoughts before I turn over to the Q&A?
No final thoughts for me. I think we've basically covered everything. It's a matter of us now working out exactly how this affects BVI and then communicating that with the community. And of course, we at the ICA, as we figure that position out, we would be working along with BVI Finance to share any information that we need to share with the relevant entities that would be affected. So probably look out for our tax in times too.
I look forward to that. If anyone has any questions, I guess they can pop that in the Q&A box. We only have one right now to pose the panel, which is, do you think BVI is going to introduce tax for companies used for investments without activities in the BVI, no substance relevant? I think the answer that we've landed there is that IFCs, with the BVI I don't think can commit to a statement right now. They'll correct me on that. But I think what we heard from Jeff is it's very unlikely that any IFCs will be looking at imposing a globe themselves. Might have misrepresented you, Jeff.
No, that is my view, because if it had been a universally adopted program, which was the original intention, and when 140 countries signed up, I guess people thought that was the way it was going to go. But as it's moved along the runway, it's fallen into a little bit of disarray, particularly with the US moves, and now it's not clear at all that all 140 of those countries are going to adopt. I think Nigeria said it's not going to. Many African countries have said they don't think they're getting enough out of it now, having had second thoughts, and they're now beating a path to the UN, saying we think you should have something to say about global tax. And by the way, can you represent us more effectively? Because we're not so sure anymore about this OECD sort of rich country club. So there's been that sort of thing happening. So from, if you like, corralling the thing and getting everybody to the same place, we seem to have, as soon as that was announced, we seem to have all split up and run off again. And that sort of connectedness has dissipated. So in some ways, I think it would have been helpful to the British IFCs for it to go through the OECD and to be widely adopted. Because you'd have had a uniform system, everybody would have known the rules, everybody would have had to do it. And as you suggested, Oliver, it would have debunked this myth that there are absolutely, mountains full of cash sitting in, Jersey or the BVI that's sitting there untaxed and it's just readily available. And we're going to be so much better off. When we see the calculations now, having done their economic studies, the figures in the overall scheme of things are actually quite small, which is, I think, strong evidence that all the transparency measures that have been put in place over the last 10, 20 years means that it's extraordinarily difficult for people to stash money away in IFCs and hide it, because it's going to get reported to their home country. So in that respect, I was actually hoping in many ways that it would get implemented, because I thought it would be helpful to our ability just to sort of put that sort of mythology on one side and kind of get on with life, really. The fact it's going to be adopted in a sort of a disparate and slightly dysfunctional way, potentially, means that it still leaves that sort of opportunity for people to insinuate and suggest and speculate and exaggerate still, because they will say, well, there are gaps in the system, not everybody's doing it, which I think is a shame, really. But yeah.
I just wanted to add, Oliver, before I have to leave, unfortunately. I think that's a very important question that was asked. And I think that the industry or the people on the call should be very aware that if the government does make a decision to implement taxes, it is not a simple shift as we have discussed before. And it's not something, it would definitely take a lot of changes to the legislative framework, a lot of changes to the way the Inland Revenue Department works and the way that the government actually works. And it would take a lot of consultation before that decision is made. So I think as of now, where the government is trying to navigate through this whole GMT and through all of this that has come about with these types of rules, people should be looking out for those types of consultations if a decision is made in that regard. But for now, I think we are comfortable in saying that we're just looking at us as a information sharing jurisdiction and participating in GMT in that way. So I don't think that the concern of implementation of taxes right now is a very big one for the BVI, but it is something that would take a lot of work before it is actually presented or that decision is actually taken.
Great. Thank you, Latoya. And thank you if you need to drop off now as well for your participation today. There's another question that's come in. Does the panel think the BVI should adopt qualifying domestic minimum top-up tax to avoid the undertax payments rule for 750 million euro or larger multinational groups only? Maybe for some explanation for those on this call, qualified domestic minimum top-up tax is a mechanism that the OECD rules specifically allow that mean that if a group would fall into the requirement to pay a top-up tax elsewhere because BVI or another zero tax jurisdiction did not have tax or imposed less than a 15% tax, then instead of that tax being able to apply, that top-up being able to be applied by France or Germany or the UK or whoever else, it would be applied by the BVI or the other low tax jurisdiction in question. And therefore, as a result, whilst the company might be hit by a higher tax rate, the revenue would go to the government locally rather than to a foreign government. Mark's gone off mute, so I assume he wants to answer that question or something else.
Well, I've got a two-letter, one-word answer to it, which is no. And the slightly longer explanation is that despite the extent to which most others, certainly in the developed larger nations, think otherwise, actually the BVI and the likes of a Jersey, the tax-neutral jurisdictions, do an important job. And they do an important job by intermediating investment. They do it actually through by providing the ability for organisations to contract and to hold wealth and assets through structures. And I'm going to say something a little bit controversial. They do that without what is traditionally thought of as there being a great deal of economic substance on the islands. Now, those things have changed a bit. I think there is an inordinate amount of substance in what the BVI and what Jersey does, but they do it without a huge number of boots on the ground. And they provide a certain part of the function, a certain part of the value chain, and provide a certain degree of security to a value chain. They are not the value chain in most of these structures. Okay, it would be completely inappropriate, I think, for offshore jurisdictions to be taxing as if they were the large chunk of the value chain and as if they did have that traditional old school thinking of what the economic substance was. So I think a measure that if the BVI or the likes of the BVI were to take up what they can now do, as it were, under the OECD rules, would be somewhat self-defeating in terms of explaining and understanding what their role is within the global infrastructure. However, what I do think is important, and it fits in with the previous question as well, two really good questions from the audience, thank you, is that actually I do think this is a really important time for the BVI to be rethinking its own tax structures. it cannot carry on. The BVI cannot carry on funding its public services on the basis of the revenues it gets from the registry predominantly. It's going to have to change, and it has to think about what that tax regime looks like. So there does have to be some real blue skies thinking in BVI in Rowtown about how does the BVI sustain and keep sustainable its public services, and where does it get that tax revenues from? But I don't think taxing large multinationals is the way of doing it.
I'm not sure, Jeff, if you have any thoughts on the QDMTT point or the other ones. Certainly on QDMTT, I certainly think that larger countries, the imposition of a QDMTT and not an income inclusion rule might make a lot of sense. It means that you remain as competitive as you can whilst being compliant with the regime. But for a smaller jurisdiction that relies on that intermediation role, that relies on being lean and relies on there being little administrative burden on companies or the government, the idea of creating that additional structure for the relatively limited amount of income that would come in because of the lack of what you might call traditional substance, I think the balance is negative for BVI. But that's my view. Jeff, I'm not sure if you want to add anything on any of the points that Mark made.
Just to be in violent agreement with you both, really. I think it would look somewhat contradictory if IFCs did that, because it is then saying, well, yes, we can look like a large domestic tax system that exists in Britain or France or anywhere else. We're just smaller. Well, we're not. We're quite different. We earn our living in a very different way. We earn it honestly and transparently with good rule of law sitting behind it, but it's a different offer. Certainly Jersey, and I think the CDs generally make their way in the world by taxes being paid by service providers. So we don't tax the capital, we're neutral. So we allow that flow of capital so it can do maximum good wherever it's going to and where it's returning from, and leave the taxing rights in the hands of those who are entitled to tax it. So we're not sort of clipping a coupon off that capital at any point in time at all. What we're doing is we're charging taxation on the profits that the service providers who facilitate that process make. And that's a good model. It's a transparent model. It's actually a non-controversial model from a tax point of view. If you start dipping into the flow of capital and dipping into the profits, then I think you undermine the presentational aspects of what you really are. You start confusing people about what you really are and how you do things. And I think also, to be honest, in terms of being sort of realpolitik, it'd be slightly provocative. Where, can you imagine a French company where Jersey was, clipping a bit of tax away, and quite how that might be reacted to? Even though there might be a perfect entitlement if you adopted the scheme as intended. So no, I think it would confuse our own community. I think it would confuse international investors. I don't think it would be a very sensible direction to go in.
We haven't got any further Q&A, but I would note on that almost in passing. There's the fact that there's nothing illegitimate about the way that that BVI structures its tax system and that provides value to the national value chain should be uncontroversial, right? That is a statement that actually, certainly amongst economists, and Mark is one, I used to be one, since Peter Diamond and James Murley's 50-something years ago, they wrote a paper saying that small countries should have lower direct corporate income tax rates because that is the only way that they can raise revenue through their domestic tax systems. And the larger a country is, the more viable a corporate income tax is. But for small countries that depend from outside capital for their flows, it is not viable to have it, and small countries should not be discriminated against based on having it. There has been a Q&A whilst my discourse on those Nobel Prize winners has gone on. There's been another Q&A question. Didn't Jersey's recent consultation conclude they might adopt a QDMTT? Has that view changed? I might go to Jeff on that one.
Yeah, so I've provided a personal view, not the government's view. And if you read their pronouncement, they put something out, didn't they? At the last year, at the end of the year before, basically laying out that we're giving all options careful consideration. There was actually public communication. So they were looking at all aspects of the scheme and leaving options open on every aspect. That doesn't mean they decided to do something. It means that they were seeking feedback from all stakeholders, external and within the industry, on all aspects of the sort of full opportunity that lay within the OECD scheme. So, I mean, of course, from a local political point of view, it'd be awfully tempting to think if you could just pick up another 10 million or 15 million pounds just by adopting a global initiative, then that you know, at face value, that would seem quite appealing, wouldn't it? So I'm sure there'll be some debate about that. But I think the reality is, you know, I think Mark's point is very powerful. If you're going to make your way in the world successfully and you're going to maintain a sound reputation and you're going to be consistent about explaining what you do and how you do it, which I think is critically important for the future of international finance, we need to do so much more of that than we have done. And if we could do it collectively, that would be even so much better. But if you start undermining that core message by starting to dabble in things that you've briefly said you're not involved in, that's not your business model, it's not how you do things, it's not how you earn your money, it's not how taxes are raised, then I do think you start to confuse external stakeholders. And I think that risk is far greater than the potentially quite small short-term benefit of a bit of extra tax, just as a sort of a unintended consequence of adopting a new global system.
Great. I've got a question for Mark specifically from the audience. You mentioned that BVI should diversify its tax base and not rely on financial services as much. And whilst that makes sense from a general perspective, diversity is generally good. Mark, are you concerned that BVI financial services business will decline significantly, or BVI government spending will increase significantly? And is there any particular driver for this comment other than the general observation that diversity is good?
Sorry, I gave a false impression of what I meant by that, I think. My point isn't about diversification necessarily out from financial services, it's actually diversification out from a pure tariff fee-based approach on the register. So something like 60% of BVI government revenues come from registry fees, and that model has been built predominantly and has developed over a period where the number of BVI BCs grew rapidly. They have now plateaued. They've come down a little bit over the last 5 or so years. Starting to stabilize again. It's not that the register is shrinking, but the register will not grow in the same volume as it has done over, you know, through the early 2000s, for example. So the BVI, I think, needs to move from a world where both the industry, but also the way in which the government took revenues from the industry was based upon volume growth. It has to move away from volume growth to a world where it's value growth. And so that's about making sure that you're getting more out of each BVI BC in terms of what professional services are delivered in Road Town. It also means the government needs to think about how it generates revenue from as a chunk of that value, rather than just hoping for another BVI BC to rock up on the register. So my point is nothing about the future of the IFC. My point is about actually the IFC needs to move from volume to value, and likewise the government has to think about how does it tax, or how does it extract value from the IFC, which is moving from volume to value.
Great, thank you so much. I think I'm going to wrap it up there from our panel. It's been really great to address you all today. I'm handing it back to Adriana, I think.
Yes, Oliver, sorry about that. All right, so that was a really informative discussion. And if anyone else has any questions that they may think of even after the conclusion of this session, please be sure to email BVI Finance at events, @bvifinance.vg, and we'll be sure to get it to our panelists today. Thank you all for joining us for this informative BVI Finance Taxing Times Roundtable discussion focused on the status of the OECD's plans to introduce a global minimum tax rate of 15% in 2023, otherwise known as Pillar 2. Thank you, Oliver, for moderating. Again, thank you, Mark, Jeff and Latoya who had to leave. Again, I'm Adriana Savral with BVI Finance. Until next time, thank you for tuning in.